Good to go, baby.
I see it scheduled.
Oh, you're good. You're live.
All right, and we are live. Okay, sorry everybody. My stream was taking a second to show me that it was live, but I'm excited to hop in and get things going here. I am trying to go live to the Twitter as well. It is giving me a classic error, as it likes to do. So I'll try this one more time, but I'm going to roll us into some fascinating chat here that we're going to be having around some incredible ETFs. And yes, unfortunately, it is giving me error for Twitter. So instead, I'm just going to go ahead and I'm going to share it from your feed straight to my Twitter. So with that being said, welcome in everybody to the stream today. Excited to be back talking about more of these ETFs, which are just blowing our minds these days with the return that they're managing to achieve and the creativity with which they're doing it. Because this market, you look at it last year, it was pretty much a Mag 7 market, right? The Mag 7 were just carrying everything. And so going into this year, there were a couple of options. Are we just going to continue to ride these, Nvidia and AMD and others like that? Or are we going to search for the value in the rest of the market that hasn't caught up? And our friends over at Granite Shares are doing both. That's the best part, right? They're actually continuing to capture the value with stuff like NVDL. But there's an incredible other option here that we're going to talk about. DRUP is the other ticker we're going to cover. And then we're also going to chat a little bit about some of the things that people just aren't even paying attention to that much, such as gold, which is also hitting all-time highs. So let's actually kick this off with DRUP, because that is the most interesting thing that I've been looking into recently when it comes to ETFs. So when you look at the stock market this year, both SPY and QQQ are up around 10%. I think SPY is up a little bit more than QQQ, and both of them are largely riding the coattails of Nvidia, right? I mean, this has just been shown. Nvidia has added, like $1 trillion in market cap? Maybe not quite that
Just
much.
about.
Yeah, maybe just about $1 trillion in market cap right this year. It's gone up 82% year to date. It's been all the way up to 93% at one point. It's retraced just a little bit from the 25th of March, but it's crazy. I mean, this is a $2.24 trillion company. I remember it being under $1 trillion not too long ago, right? It's trading at $900 a share nearly. It's been up to $950 a share. And of course, this is making up a large portion of the gains that you're seeing in QQQ, right? In SPY. This is a top 500 tech company in the US. And so when you look at QQQ, which is up 9.5% year to date, you best believe that Nvidia is absolutely carrying that, right? There's stuff that's going down outside of that. So why do I go to say all this? It's because fund managers are now put into this interesting position. All right, are we going to ride Nvidia, or are we going to find the other value in the market? I think that they have done exactly that, being able to not just keep up, but beat market return without having to have the risk of having Nvidia. Because admit it, right? There's risk not having Nvidia in your portfolio, and there's risk having Nvidia in your portfolio.
There is.
Both ways, right? There's opportunity cost if you don't have it, but if you do have it in there, you also run the risk of, hey, this could all come crashing down at some point, right? As fast as we went up, we can come back down 20, 30%. No problem.
We can.
Right? Couple of fund managers just taking profit. So that's why I want to look at DRUP, which I believe you have pulled up on for us.
Unbelievable chart here.
Yeah, so talk to me just as like looking at the chart first before we go into it.
So I mean, clear and simple, like buyers are showing up to the party above $32. You can see that when they listed, they're trading about 25, went as high as 30, and off the lows of, again, 2020 COVID fear and panic down to $19. I mean, talk about the hell of an opportunity to buy something like this. I'm assuming at the time it was such a new product, people are probably a little hesitant to jump in, especially at that kind of panic in the market. I, for one, will admit the shame of selling the amount of like Caterpillar and like really good names that I shouldn't have sold. But again, I thought the economy was in free fall. We're all going to die. This is going to be terrible. So I did what I did. We live and we learn. But finding opportunities like this, I mean, that's your hidden gem in the market. Obviously, the smartest people in the market knew what was up and were grabbing their positions in this, I would assume. And you can see that we've traded from that 19 to a relative high of 45, right? Created our range from about 32 to 45. So buyers and sellers are jumping in here. Buyers here, sellers here. We like to create an easy and understandable range. I think that's one of the best ways to look at analysis, to really understand accumulation and distribution with some of these larger funds and larger fund holders that really have the money to move the market. And you can see that, they've loved the opportunity to buy. But what's even more interesting is that the biggest fluctuations AUM happened actually in July of the 2020. through about November of 2020. But what we're seeing now is like there were some large outflows. What I like the most here is look, you've got some huge outflows here. So August of 23, I mean, to be honest, I feel like there was a lot of fear surrounding tech, so it makes sense that this was happening. But what's even more interesting is that sellers came in droves. I mentioned it's take profit time, 3 years post date opening, which means hey, typically a lot of these funds, the way they work, guys, this, we've talked about it before. You got a timetable before you can really start liquidating the position you took at IPO, right? And we're at about the 3-year mark. That's historically a pretty common theme, I'd say, across these, that you'll see that 3-year mark hit. And I mean, for those that bought in at the IPO and before the IPO, obviously, we're coming in probably below $25 cost basis and selling at a double your money price isn't a bad idea. But what's more interesting is that the market didn't care. The market just didn't care, and this thing took off. Now, again, I'm glad you brought up that point about Nvidia. I feel like a lot of people look at this and they go, oh, Nvidia, it just makes sense. No, because there is no Nvidia. They've managed this return sans Nvidia. To me, that's what makes this it's the most interesting thing I've looked at as far as ETFs go. Excuse me. Because of that reason. Thank you. The Nvidia has carried every single major tech index for the most part. This one doesn't touch it. Yet it's still posted such an impressive return. And from a setup understanding, right, when we're trading above this $45 range, we're back into price discovery mode. So look at Nvidia, right? When we cross that threshold of previous high, you guys, nobody knows what it's priced at, which means, in theoretically, go to infinity. There is no basis. There is no resistance. There is no support because we are just on a mission of price discovery. And I think that's where this fund is right now. They're in a function of price discovery. And it really, to me, poses an interesting question of like, if I want upside in tech, where can I get it? Should I continue to take the risk of Nvidia being up thousands of % over a matter of years? Or do I look to more innovative and obviously a basket of innovative companies such as this? I mean, what do you like about the holdings here? Like what interests you, I guess, just right off the bat?
Yeah, so I think that they went for some of the less sexy names that are just continuing to clear all-time highs. Honestly, their top 4, 5 holdings just really speak to me, right? They're not chasing the Nvidia, which everyone was on, but Microsoft and Meta are 2 of their top holdings, and Google's their 3rd. And I love the Google stock. I mean, that's one of my favorites. Google stock hit an all-time high today. They're currently pretty much sitting at all-time highs. Meta recently cracked through 500. They set all-time highs basically a month ago, and so they've been holding this. And especially if you caught that move up on February 1st, which they did because they already had this inside the portfolio, you were doing good. And then Microsoft, which is basically number 1 company in the world pretty much when you're looking by market cap, is also sitting here pretty much right at all-time highs. I mean, the Microsoft weekly chart is insane.
Right.
And these are names that are going overlooked because they're not putting up SMCI and NVIDIA numbers, but you can build a really strong portfolio. And here's the beauty to it, and this is why people should be using ETFs. This is an actively managed ETF, right? These names can change over time. And instead of you having to be the one that consistently is looking and pivoting and putting new things in, they take care of it, right? This is not even a 80% tech ETF. It's 63% tech, 22.5% healthcare, 13.5% communication service, and there's even industrials in there. It's pretty widespread. And they've got Microsoft at a 10% position and Meta at a 6% and Google around 6%. Then nothing else is even over 5%. So you're pretty well diversified. They even have Broadcom in there. I mean, I love Broadcom stock.
I do too.
AVGO up 23% this year.
I even like that they have Texas Instruments. To be honest, that shocks me, but it makes sense. I mean, what this fund would at least first look. I think they've done a pretty damn good job of merging the old and the new. Like, Absolutely. Look, we need the stability and trust of
and your expense ratio is only 0.6.
Yeah,
it's not high at all.
Yeah, you really aren't going to beat that right there. I mean. That's unbelievable. So it's still got 0.07. 0.07 would be their NAV discount. So basically trading below what their actual market price. So yeah, there's their fees, base rate, NAV is currently 52.24. 30-day distribution. I'll be interested to see how they expand the dividend aspect. Because that, dude, if you can get tech growth, disruption, and dividend, to me, that's for the next 10, 15 years. Dude, so look, a couple years ago, I talked to this guy who's brilliant. He said to me something that has never left my mind. It's one of those things that gets etched in your brain. He said, understand this: tech is the new value. And at first, I didn't really understand it. And then it kind of set in after a year. He's like, everyone used to go to, even as far as consumer defensive and looking at like Walmarts of the world, right? Like that's where money goes when it's scared. It goes to like true value. Like we're looking real estate, commercial and residential, looking at REITs holding those kind of positions. I think now safety is scalable tech. It's insane to me. That is like my brain can't wrap around that idea, but it's where we are.
Yeah, and I want to just continue this comparison because what people are going to put this up against is going to be QQQ, right? And QQQ, we all know, had a crazy year last year where it just way outperformed. But even if you look at this, right, so this is already outperforming QQQ year to date. On a 1 year, just rolling past 1 year, it's only 1% less than QQQ. And when you go back to the massive drawdown that we had from 2021 to the 2023 area, that drawdown actually, it was 3 to 4% less of a drawdown on DRUP than it was on QQQ. So you actually suffered a slightly lower drawdown, and it's beating it year to date. And even in the craziest year last year for QQQ, it was only 1% less without Nvidia.
Yeah, I mean, this is, to me, this is something else. I think what you mentioned is something very important for everyone to understand is this drawdown, right? So you're talking 28% on par with most tech, 50. I mean, really, at least 40. I would say it was at least 35 to 40%. This saw the attrition, I'd say the attrition rate was much less here. More importantly, the outflows don't look like they matched everything else. I mean, now remember, volume is a relative term, right? So like volume is always relative to what it was for this specific fund. But I would say just on the whole, seeing only a 28% drawdown, very impressive. What's more impressive though is the small amount of time. So look, we start here November 21 and we talk to like the very bottom October of 22. So realistically, you've got, you know, almost a year of attrition in the market, right? But we saw that across the board. That's not unique to this one. What's even more impressive is this accumulation, quiet accumulation, because look at the inflows are not insane. Like to me, that's smart money that just wants to quietly start levering into a position. And then within what? Another year, they had already recaptured this initial loss from 45 to 32. And then they put a couple extra bucks on top. So as far as the fund performance goes, relative to the Qs and everything else, that's a shocker. I was just looking into, so I was like, okay, what makes, for those that don't know, what makes up the Qs, right? Kind of stop here. I don't think you really need to look at everything else because it's so heavily weighted. I like the idea that you're not seeing all those names here. Now, it's not to say don't buy Apple, right? Like, oh, I don't like Apple. That's not what we're saying here. What everyone should care about in the market always is a perpetual and absolute, right? Where's the value going to be now? Where am I going to make money now? Not just now, next 3 to 5 years, is who has growth and upside. So Microsoft, simple. I mean, love him or hate him. I mean, not to say he's fully involved anymore, but love or hate Microsoft or Bill Gates. I mean, their ability to scale into enterprise it's unparalleled, right? They made the smart migration into their cloud services. Genius, brilliant. It was wonderful. It was a smart move. The same way I think Amazon has done a pretty good job, which isn't held here. So I'd say that's the only thing that I would change if I was in charge.
Yeah.
I would throw a little Amazon in there, but
sure.
is what it is. I love the Alphabet. I agree with you completely, Wolf. The Alphabet Holdings, I think Google is well positioned, and the way that they decide that they're going to truly leverage AI, I think is going to determine whether or not Google becomes the most explosively growing company over the next 10 years or not. And if they do it right, I think they will, because remember, guys, they own search. You could say TikTok's taking sure. But 30 and up, at least speak for myself. I mean, let me ask you. So 30 and up, I'm a Google guy. I'm going to Google it. That's just what I'm going to do. So you're a little younger than me. Do you truly go to TikTok for search query?
No.
Exactly.
I'm definitely going to Google. I think that for me, TikTok and other social media, well, that's okay. So I mean, it's different depending on the social media, but TikTok is still entertainment to me. It's not where I would go to get serious answers. Twitter is where I would go for news, right? Something happened in the world, right? I want to find out who saw it first. I go to Twitter, but for search, I'd go to Google. But then ultimately, I think that the big change and the reason why I'm so bullish on Google is there's going to be a point where one day you go into Google and you start searching things and it's just straight up Gemini instead of Google search built into there. And you're going to start getting full on AI answers and it's just going to change. I mean, right now it's much more useful to go into one of those things and use it as a search engine, but it's not how it's optimized just yet. So I think Google, with 92% of the world's search traffic, is so well optimized to capitalize off of AI. And they just haven't done it yet, right? I mean, they've been beta testing the product. They came out with Bard. They changed it over to Gemini. They're giving everyone a month or two free right now on Gemini Pro. And then eventually this is just going to be what Google is. It's just going to be the search engine.
Yeah, I mean, well, they already own it. Like if you look at PPC, right? So some of my other businesses, we leverage PPC heavily. I gotta buy the traffic. I mean, we have a good organic presence, but at the end of the day, if you want like high converting, high intent traffic, you have to buy it. So, guys, that means anyone with like a service or product looking to reach a customer, you gotta pay for it. It's just the reality we live in. Sponsored posts are going to take the top. They're going to be the creme de la creme. I think Google has done an exceptional job really cultivating like a very user-centric experience. They want to, that's their number one mission. The Google algorithm's number one mission is to serve you. How can I give you the most relevant result that I possibly can so that you are so satisfied you keep coming back for more? And they've done that in spades.
You know what blows my mind is when we were looking to talk about DRUP, and I'm not sure, by the way, how many total listeners we have. I see several hundred have come through while we've been talking. Hard to tell exactly how many live, but just look this up with me if you're on here live.
Yeah.
When I saw DRUP, my first instinct was, why is nobody talking about this? I then went and I tried to look online and to see like, okay, well, like who is analyzing this? And there's a million websites that come up when you type in DRUP, but all that they show is just, you know, classic fund info of like, oh, here's the expense ratio, here's the holdings. There's nobody that's actually doing real analysis on this. Like we've been showing here where like, all right, well, here's the actual holdings and here's the chart and here's this. Nobody's even talking about this thing yet. No. I think it's going way, way, way under the radar.
And and then they'll act like they knew about it all along and that they're bringing you the good stuff when you're getting it here, always first.
Yeah, I mean,
because look,
it's literally
the conversation we had earlier, right? It's like you got the traditional kind of mainstream media that's, I mean, they're going for the cues. They're going for the big ones. And I get it. And I mean, don't like, it's Granite shares. So like do the math, go ahead, look at their total net cap holdings. I mean, you'll be shocked. It's not a small company. But they've been the most innovative, in my opinion. They've been the most innovative with stuff like this, products like this that actually, to me, speak to a younger generation of investor that does want to see that disruption, that does want to see that evolution of technology, but also realistically, I want like it's what I said when I saw Texas Instruments in there, it kind of gave me a piece of like, okay, that's standard value tech. It's been there. It won't go away. That's Americana, I guess, if you will, Americana tech. And so I love it. I think that they're setting themselves up for a very successful future here if they can continue innovating and finding those wins that exist outside the 1, 2, or 3 that everyone else in the market's following. I think that's really going to be that'll be their real, I think that's how you champion them in the end. Taking a quick look at Morningstar here, seeing what they say. It looks like they have picked it up, but it doesn't give me, I'm assuming I have to pay to see that.
Yeah. Nobody's giving out just like a free overview. I went on Seeking Alpha, and the last person to write an analysis on this was in July of 2022.
No,
people just haven't even been looking at it. I think people gave up on a lot of tech and stuff like that when we had a really big drawdown back in 2022. And so you can see people looking in July of 2022 going, I don't know, maybe this is, just a hold or something like that. And of course we're up, that was trading at around $36 at the time. Now it's trading at 50. So it certainly had a bit of a move. And as always, I like to run a diversified portfolio. And that's why ETFs are so beautiful, because I could go and I could put 10, 15% of my portfolio in something like this, but knowing that it's diversified across a variety of other assets and that there's somebody, a real fund manager, that's going and actually making those consistent updates, rebalancing, everything along those lines, right? If they see something in the market that scares them, that's their full-time job, is to be watching it. And so it's fun to pick stocks. I do it myself, but I think ETF should be a staple of any long-term investor's portfolio, especially ones like these.
You have to. You have to. And I mean, it's the same. I follow the same philosophy. You know, I'll have my active trade money, but at the end of the day, I'm gonna push a majority of that portion into managed products. Like I don't want to have to know who's going to be the next disruptor. How much should I have? How should I balance this? What allocation should I make? So if I have 100 grand, right, guys, like you never want to put it just. I mean, if you have $100 million, sure, you're going to throw 100 grand into one position. I'm not that guy. I don't have that kind of money, so it's not going to be me. Probably not any of us on this stream. Maybe, maybe not. We're not just going to want to willy-nilly throw the entire lot into one asset and hope that it outperforms and that we don't get shelled. But at the same token, it's like they have a team of analysts that are constantly just doing computer things and maths, calculating whether or not this is the right asset to be holding at this point in time. And I think having that it offers that peace of mind, especially with such a low expense ratio. I mean, come on.
Yeah, and this is also not a random ETF provider. Granite Shares per stockanalysis.com is the 44th largest ETF provider on the entire US stock market. And so that's really, really good. They're managing like almost 4 billion in assets, potentially more. And I mean, this article is probably not the most updated. It doesn't have a date on it right now. But then the other thing that's cool is it says that their funds have an average expense ratio of 1.08, which makes me even more impressed with DRUP because their average is double whatever what DRUP is at 0.6. So this is half of the expense ratio for, to be honest, one of the best performing products on it. So, if people in the audience have any questions on this type of stuff, feel free to let us know. We're happy to look through. They also do distributions quarterly. You can see all the information on the website, but yeah, DRUP is certainly one to have on your watch list. It is, it's been running for 5 years, and at no point in time has it been a bad investment because during the drawdown, it outperformed, right? It didn't go down as far as QQQ. And during the run-ups, it has held pretty steady. Like I said, outperforming it this year, only 1% less than it over the past year. And QQQ also has an expense ratio. It's not like it's free or anything like that too. So some good pieces there. Any other thoughts on DRUP, or you want to talk a little bit about BAR for just a minute?
I do want to get into BAR for a minute, but really quick, if you guys are watching us on Twitter, whether you found us on the Wolf page or our page, you guys can actually reply in comments, and we'll show up on the stream. If you do have questions, I really would love for you to have an opportunity to ask those questions and get those thoughts. If there's any, especially if it's Granite Shares. I mean, so look, be very clear. That's what we like to do is we like to go to these companies that we already like and we think have innovative products and basically get them to come on the show. I mean, that's the whole idea. It's like, I want to find good quality things that we can do for free to you guys with providers that actually have products that you'll like and care about. And I think this has probably been my favorite so far because you don't have upside like this in many areas, unless, again, you're holding the Nvidias, the AMDs, SMCS, which have run thousands of %. And at this point are getting quite a bit, I'd say quite a bit dangerous for any of the short-term investors because, look, if you don't have a 15-year outlook, right now is a time in which I'm personally being very careful with entry into any of those assets because look where they're at. It's kind of, when they always say, when the shoe shiner asks you about a stock, it's time to sell. And everybody and their mother is talking about Nvidia. That should be enough, case in point, not arguing about the fundamentals of their business because, I mean, they have growth, right? But as far as you, for an investor, what your main prerogative should always be, where do I get the most upside? And where's the value now where my entry into this specific position will offer me the greatest upside with the lowest amount of risk over the next couple of years and find that opportunity. But with that, I'd say we can move on. So you wanted to jump into BAR, right?
So I just wanted to talk BAR for a second. I actually had the chance to talk with Will Rind, who is the CEO of Granite Shares. And I basically asked him, the question that anybody asks to people that are making ETFs that are along the same lines as similar products, right? Why would I purchase your ETF versus just buying the one that does the exact same thing that's already existing? And he gave me a great answer. So the classic, when people think of Gold Trust, they think of GLD, right? Gold, GLD, the SPDR Gold Trust. Austin, off top of your head, without looking, how much AUM do you think is inside of GLD?
Billions?
Many billions, yes. 59 billion to be exact. Yes, this is a very, very popular product. And why shouldn't it be, right? It's a very easy way to purchase exposure to gold. It is currently sitting at all-time highs, right? It's up about 70% in the last 5 years. It's about almost 400% all time. since they launched this back in '04, so about 20 years. And it's a popular product, right? People think about gold and want to have interest in it. So with that being said, they have a very, very similar product at Granite Shares, and it's BAR. Now, BAR is becoming more popular. It actually just hit, it's flat right now, $1 billion in AUM, exactly $1 billion. And this is where they're basically holding physically held gold stored and secured in vaults in London, and you can buy, very similar to GLD, access to it. So the question becomes, all right, well, why would I buy BAR over GLD? When I look at the 1 year on each of them, it's actually, well, here's a couple of reasons. First, I didn't realize it was going to be this big of a difference, but GLD on the past 1 year is up 12.9%. BAR in the same time period is up 13.1%. So you do have a little bit of outperformance there. But the biggest reason why, and this might be leading to the outperformance, is the expense ratio. And so we kind of touched on this a little bit with DRUP having a pretty low expense ratio. But when you look at GLD, so you're going ahead and you're buying your gold, and your expense ratio you're paying is 0.4, right? Relatively low. But when you go and you look at BAR, they drop that all the way down to 0.17, which is one of the lowest expense ratios I've seen on anything out there when it comes to the ETF world. That's lower than the expense ratio on QQQ, which is 0.2. So this is half, less than half, because you're going from 0.17 to 0.4, less than half the expense ratio on GLD. So I just thought that was a little interesting thing. Obviously, I just like talking gold. I mean, it's breaking out all the noise.
It is. Hey, but for any new listeners, just to quickly explain, what does that expense ratio cover? What does it mean, and what does it cover? What are you paying for?
So you're paying for essentially the fund management, right? You're having the fund, and it's why it's higher in a case of something like DRUP. But this is the cut that the fund manager gets to make it worth their time to manage this fund for you as an investor. So essentially, when you're giving them your money and saying, hey, here's my AUM, right, my assets under management for you to manage, I'm going to pay you a management fee of those funds. And that's what the expense ratio is. And the more complex a fund is, typically the higher the expense ratio is going to be on that fund, because the manager's putting in more work. So with a gold fund, of course, it's going to be relatively low. They're just going and buying gold. Now, there's maybe other ways you can try to get exposure, but you're going to usually have to pay somewhat of an expense fee for something like this. They're making it very easy for you to purchase access through an ETF versus literally having to go buy physical gold. You still have that physical gold being held by them. So that's what the expense fee is. In this case, it's them basically being that middleman saying, hey, we're going to go ahead and we're going to make it really easy for you to buy access to gold. In exchange, we're going to just take 0.17% of the assets that are under management with us from you as an expense ratio. Now, that is per year. So that's annually. Now, if you only were to buy this and hold it for 6 months, you would chop that number in half, right? It's actually prorated to how long you hold.
Beautiful. No, I appreciate the explanation. I think it's good. You guys always want to understand what it is. Anytime you pay for something, you want to know what you're paying for. And you nailed it. And again, it's finding same quality product for lesser cost to you, the investor. And that's what we're looking for here. Is where's the arbitrage? Where do the opportunities exist?
And you actually bring up another good point, like an example, just another comparison just from DRUP. DRUP is a tech innovation fund, right? Well, what's a very famous tech innovation fund? ARKK, Kathy Woods.
Kathy Woods.
DRUP has a 0.6% expense ratio, ARK 0.75. So it's actually even lower than the competition there as well. They're just really continuously beating their competition, both in performance as well as the expense that they're taking. So imagine I told you, hey, I'm going to manage your money for you, and I'm going to make you more money than the other guy, and I'm also going to take a lower cut.
Yeah. I mean, do the math there, guys. And look at performance too, right? I mean, you got to keep that in mind. Like, sure, yes, unprecedented run, but why has ARK not seen the same upside that we've seen in the other more disruptive and, in my opinion, more innovative funds? Those are like questions you always want to be asking yourself.
Right. And do you know why that is? It's because Kathy, unfortunately, is just trying to move a little too quick, right? And so they actually had some really solid holdings. They had a ton of Coinbase. They had a ton of some other names, and they sold out of them because they're just trying to trade these markets too actively, versus DRUP, which has basically shown we're going to just build conviction, and we're going to buy and we're going to hold names that we're convicted in.
Yep. Now, to be very honest, like I do love the ARK holdings as they are current, but to his point, it's, do I trust them to make the right decision and not be impulsive? How many times, you guys, have you seen an impulsive Kathy Woods buy or sell. I mean, think about yourselves, right? Think about all of us as investors. We've all done it. We've all done it at a point in time, like panic sell, panic buy, FOMO buy, whatever you want to call it. We've all done it. But when you got someone managing billions that's still doing it, you got to really ask the question of like, is this the best place to put my money right now?
Exactly. Yeah, I think that makes sense. All right. I think we hit pretty well on both of these. I would just say, continue to keep an eye on gold. I was getting a haircut the other day, and the guy, I asked him if he invests in anything, and he goes, "No, but I wish I invested in gold." And then he goes, "But now I'm not going to buy it because it's too high here." And I just want to real quick address the fallacy. If you look at the data, those that buy at 52-week highs perform much better than those that buy at 52-week lows. Just saying. So continue to.
That's an interesting data point. I never heard that before, but it makes sense.
Yes. Momentum is a real thing in the market. It attracts more investors and stuff like that. If you're looking to build a position in a DRUP, in a bar, whatever it is, don't let the fact that something is at all-time highs be what scares you. If people had that way of thinking with Nvidia, they just missed a 200% run.
Yeah, and those are two funds I would definitely check out. Again, we've talked a lot about them. Just to kind of finish this out, round it out, the chart for bar here. I mean, as he mentioned, you don't see the same run. So here's the question I always like to ask, right? For any new investors, like what has run, what should have ran, but has not yet? Then the third question is most important, why? Sometimes markets are just a little slow to catch up to themselves. And that's okay, because remember, stock market economy are often disjointed. When you get those positions of opportunity, arbitrage, right? You got to take them. And I will tell you this: take a look at these circles right here. Let me ask you this, Wolfie. What do you see there? Because I see something interesting.
I see green lines that are a lot larger than those red lines.
I see some big boys buying. Somebody is loading the boat and they're building a beautifully accumulated position. Basically, look, this is why it's so important to highlight these levels with just horizontal lines, guys. Do not fall into the trap like fib fans, fib arcs, blah, 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 blah. It doesn't matter. Two horizontal lines will tell you everything you need to know. Find out where the price stabilizes and then find out who's buying there. If they're smarter than you, it's worth taking a look at. And you can see that they're buying $15. They're buying 19. They're buying 17 and they're buying 16. And this is, I'm assuming, billions at this point. If you're talking over 11 million, it's billions, right? And now making millions on the upside.
Yeah, and this is on a weekly chart too.
Right. That's big money. The daily, I imagine, is even more intense. But that tells me all I need to know. So, Sean, on Access question, what indications lead you to believe DRUP will continue to rise after such a good run?
I was hoping we'd get this question because that is the entire thesis here, right? The reason why I believe they'll continue to rise is because they made this run without having the one stock that is carrying the entire index. They're not a one-trick pony, right? They're actually doing their research and finding quality names and rotating into them. That's my entire thesis is why I also think they'll keep going and why I think QQQ could take a hit if Nvidia was to come down.
Yeah, and they absolutely could. You made the best point I think anyone's made all day is that it's all about the right, and not to get into time the market, but the right rotation in the right frame of time. It doesn't have to be day, week, month, but the fact that they are finding quality names totally detached from NVIDIA. Go look at how much NVIDIA's carried the market, my friend Sean, my good friend Sean, which we're now best friends. And then take a look at the fact that they've seen this kind of performance without it. That to me is also the biggest selling point. Is like, look what they've done without it. Now that means that they've found a secret that no one else is really looking at. And that's what I care about. Everybody knows NVIDIA ran. Everybody knows why it's run. Everyone understands that value proposition. But the opportunity to make money from it has diminished every cent that it's gone up. You need to find one that has the opportunity to make more money before that opportunity passes you by, in my opinion. When this is trading at, say, 75, 80 bucks, whatever it ends up at, and if it continues to run, then we start talking about how much upside is really left how much meat is left on the bone here for us to eat. It's a different conversation. But again, relatively new fund, so always carries more risk. But the fact they've been able to actually do what they say in terms of disrupting and building a product that actually will perform without basically the best kid on the team that hits a home run every time he's at the plate, to me, that's a better team.
Oh yeah, let me close this on that point. This is Moneyball. That's what DRUP is doing right now. This is literally the concept
Such
of
a great
Moneyball.
movie.
And it's Billy Bean coming in and saying, we're going to beat the $140 million payroll Yankees with a $35 million payroll, because all that we care about is can you get on base, right? Can you get on base? Can you do this? Can you make the base hits? We do not care if you're the dude in, hitting homers and all this and all that. Can you get on base, right? Because that is going to stack up base hit, base hit, base hit. And that's what they've put together here. So that's how I would compare it.
That is a number of series of base hits without and then they bring the runs in. I love it. No, and I think it's worth looking at. So I think that's a great point. It's a great
Beautiful.
point.
Cool.
All right.
I think we hit all the questions. Appreciate it, Sean. Hope everybody enjoyed. I'm looking on X right now, and I see we had about 1,300 people come through during this. I
Hell
think we only
yes.
ran for about 40 minutes as well.
Yep.
So nice to see that. We will get back and do another one of these in the near future. If you had any other questions or things that you want us to do them on, feel free to comment that on whatever platform that you're watching on.
Beautiful. Thanks, guys.
Thanks,
See you
everybody.
soon. Bye bye.